Hi everyone, I am Lindsey. Today I will walk you through how we use sensitivity analysis to make smarter capital budgeting decisions. You will see the goal of financial management, the steps to run solid sensitivity tests, and the internal and external risk methods that make our numbers more reliable. Let us begin. The core of financial management is simple. Grow firm value. We do that through three functions: capital budgeting, capital structure, and working capital. Capital budgeting decides which project deserves our money. We rely on NPV and IRR, and we pair them with disciplined cash flow estimates and risk-aware discount rates. As you listen, ask yourself, if this was your money, what assumptions would you challenge first? Transactions. We know the goal. Now we test how fragile or resilient our project value really is. Sensitivity analysis asks a clear question. If key input moves, how much does value move? We start with a clean base model. Then select a short list of drivers: price, volume, unit cost, CAPEX, working capital, and WACC by changing one input at a time and watching the NPV or IRR. We learn which assumptions matter most. This gives leaders clarity. It also guides our due diligence and monitoring plan for approval, after approval. Next, I will show you the exact steps. Step 1, set realistic ranges for each driver, often plus or minus 10 to 30% based on history, peers, and contracts. Step 2, vary one driver at a time, relic NPV or IRR, and record the change from the base case. Keep the sheet transparent so everyone can trace the math. Step 3, rank the drivers by NPV, impact, and build a tornado chart. The longest bars show the variables that move value the most. Step 4, find break-even points. For example, the minimum price or volume that keeps NPV at 0. Optional. Stress the edges to see if behavior changes near capacity limits. Step cost or taxes. Quick check for the class. If the price and volume both look uncertain, would you test them together or one at a time? For sensitivity, we test one at a time, then we use scenarios for combinations. Let us add judgment to the numbers. Numbers without context can mislead. Add 3 checks. First, plausibility. Is the range believable and who controls it? Second, ownership. Map each risk to a specific owner, a control, and early indicator. Third, story. Write a short narrative for why the variable might move. For example, a new competitor, a supplier change, regulatory delay, or a faster adoptive curve. This pairing of ranges with stories help us avoid false precision and keeps everyone aligned on what to watch. Now we plug risk more formally into the model. Inside the capital budgeting model, we have several tools. 1, a risk-adjusted discount rate, either WACC or a specific rate if the risk is different from company average. 2, certainty equivalence. Adjust cash flows downward for risk, then discount at a safer rate. This keeps the risk in cash flows, not only in the rate. 3. Scenarios and Monte Carlo. Scenarios show the coherent features. Monte Carlo samples. Many paths display a distribution of NPV. 4. Decision trees. Useful when decisions unfold in stages. For example, pilot scale exit. 5. Simple. Break even and margin of safety test to show how much room we have before value turns negative. Transition. Internal methods are powerful, but we should also show our assumptions to the market. External inputs. Make a model credible. Use CAPM, beta, and peers to estimate the equity, risk, and then WACC. Look at credit spreads, lenders, covenants to gauge debt cost and constraints. Consider hedges and contracts. Long-term supply deals, customers often take or price collars. These instruments can narrow the ranges you test in sensitivity analysis. If you lock in floor price, your downside bar on the tornado chart should shrink. Now we pull everyone together for discussions and for monitoring. Here's the practical workflow. Build your base case. Run sensitivity on the top drivers. Rank the bars. Combine rankings with short scenarios. Focus your due diligence on the biggest bars and scenarios that explain them. Approve projects that keep positive NPV across the most plausible ranges or add risk mitigations that move the bars in your favor. After approval, monitor the top 3 drivers monthly or quarterly. If a driver drifts toward break-even point, escalate and adjust early. Thank you for listening and for giving this session your time and focus. I appreciate your attention and the ideas that you brought to the room. Thanks again. Have a nice day.